If you want to become wealthy, you have to understand this formula. Your income minus your expenses equal your assets plus your savings. We are taught that if you want to become successful or more successful, you need to focus here on your income. The bigger your income, the bigger your wealth. But unfortunately, that's one big lie. Your wealth is not determined by your income, your wealth is not determined by your savings, and your wealth is not determined by what Gucci belt, what Louis Vuitton, what car you drive is not determined by your expenses. Your wealth is determined by your assets. If you want to increase your wealth, you need to increase your assets. How can you increase your assets? You have less expenses or you have more income. This is where you have to understand how to become wealthy, because most of the time we're told to focus just here on your income. Now, your income can help, but what happens to so many people is they get caught up on this idea of becoming wealthy by just having a big income. The problem with having just a big income is you can have a big income, but if you have no assets and then that income goes away because you break your leg, you get sued, something bad happens. Now your income goes away. Well, you used to have a big income, but now you have nothing. Wealthy people are focused here. They're doing whatever they can to increase the amount of assets they have, that where their assets cover their expenses, because as you grow your assets, this will start paying you an income, and that will hopefully be able to cover your assets. That way now you're free, because once your assets cover your expenses, now you're financially free. Your investments pay for your lifestyle, and you don't have to worry about money anymore. The problem is we're never taught about this. We're not told how to invest our money. We're not told how to generate cash flow. We're not told what passive income is. We're only taught to work here. How do you get a job? That way you can get an income. And that's good to get started. We all need an income, but the question is, what do you do with this income? That way you can get these assets. I got an email from one of my subscribers the other day, and essentially what the email said was that this lady has been stuck in the rat race for a long time. That she's been working to increase her income, but every time she did, she increased her expenses and had a hard time putting money aside for her investments. And now she's finally had some money to put aside for her investments, but she has all this debt that has been piled up over the years, that she's been taking this money that she's putting aside into her investments and throwing it all into this one stock that she hopes will grow significantly in the next couple of years, and that if her stock grows by 2 or 3 times in the next couple of years, then she'll finally have some money to pay down her debts. So this asset that she's investing in is very risky, hoping for a big home run gain. That way she finally gets that windfall that she's been looking for to pay down her debts. And this is where now you want to understand the first thing. What type of assets are you investing in? One thing that every single school should teach before you graduate school and start working is this. If you invest $4 a day and you start investing when you turn 21 until you retire at say 66 years old, and you just throw this money into the market passively, you don't even think about it, and you can get an average stock market return, which is just 10% a year, you will retire with over $1.1 million. You will retire a millionaire off of your $4 a day investment if you just stay consistent, if you just keep automatically, passively investing this money into the market. And this doesn't mean you have to get a 10% return every single year. It just means some years you're going to get more than 10%, some years might be less than 10%. But on average, if you can get that stock market return, you are going to retire a millionaire with just $4 a day. But the key here is you need to start when you're 21 years old, because if you don't start when you're 21, you're not going to get the same returns. If you start learning about money a little bit later and now you start putting money aside in your mid-40s and you do the same thing, you put aside $4 a day and you can get the same 10% return, well, you're not going to retire with $1.1 million or $1 million. You're not going to retire with $750,000. You're not going to have $500,000. You're not even going to have $250,000. In fact, you're not even going to have $100,000. If you start investing when you're 45 years old with the same $4 a day, well, now you're going to have about $90,000 when you hit retirement. You can see there's a big difference, and all depends on when you start. This is what makes people want to now look for the riskier investments where you can see the big growth. You start gambling, you start looking for something big. I remember when I was a kid, every time we would go and pump gas, my dad would always go and get a couple lottery tickets, and I would always ask why are you getting these lottery tickets? And he would say, well, if I hit the lottery, I'll finally be able to retire. We start thinking about ways that we can get the big wins, the $1 million wins, the big payday, instead of thinking about how we can get the slow, steady returns. Because the reality for most people who become wealthy, this is not the people who go out and start a new business and sell it for millions of dollars. I'm talking about for regular people. You work a job and you want to become wealthy. The way that you do that is by slow, steady, consistent investing. If you're not interested in doing all the research of investing into different companies and researching their companies and listening to earnings calls, if you're not interested in investing in real estate, if you're not interested in buying a business, well, then the next best thing is for you to just steadily, consistently invest your money into stable, long-term investments. That way you just keep putting your money in every time you get paid. And if you do that consistently, the more money that you invest, the more wealth that you will build. But it requires you to stay consistent and constantly keep chipping away at trying to build this wealth. Once you start doing that, that's when you can ask yourself how involved that you want to be with your investments. Because the more risk that you take, the more potential returns that you can get, meaning the more money that you can make. But you have to understand the risk. And you got to understand how comfortable are you with risk. If you're young, you want to get rich, you want to do big things, you got to be willing to take on more risk. If you just want to live financially free and comfortable and not have to worry about money, you're okay with not flying in a private jet, well then you don't got to take all the big risks. And you need to understand what type of risk you want to take. Now, if you want to start taking on more risks, the next thing that you can do is look at investing in individual companies. You can start learning about reading earnings calls. How do you value a company? How do you find a good undervalued company that you can buy and hold for the long term? I'm not a trader. I don't know how to trade. I'm not a flipper. I'm not a gambler, and all of that is like gambling to me. So for me, I like investing in companies and holding them for the long term. Then you might want to consider investing in real estate. I love investing in real estate. Investing in real estate gives you consistent cash flow because now you can buy a property, a house, an apartment complex, an office building, a mixed-use building. You buy a piece of property that you can see, feel, and touch. It's tangible. So you're not going to see these major 50% market swings in a day like you can see in the stock market. So you have a little bit more stability. You have something real because when you own a building, you have the bricks, you have the land, you have the windows, you have actual cash flow because when you buy a building, somebody or something is going to be living in or using a property, and in exchange for them living in or using a property, they're going to pay you rent every single month. So it's putting money in your pocket every single month, meaning you're getting paid without selling your property. And if you own enough real estate, now you have enough cash flow to live your life. And real estate provides some of the best tax breaks that our tax code has to offer. Now, I'm an attorney, but I'm not your attorney, but real estate is a great tax haven, which is why wealthy people love owning and investing in real estate. And the best part is once you understand how to invest in real estate, it can be completely passive for you because you can hire a property manager and you'll be able to build a team and systems so you don't have to be involved. But this is where now you have to understand how involved do you want to be with your investments? Do you like the idea of being a business owner, of being an investor and doing these types of things? Or do you just want to continue working a job and throwing some money away at your investments? I can't tell you what's right for you, but this is where you have to be honest with yourself and make sure you're doing the things that are going to help you become wealthy, because whether you work a job, whether you're a business owner, whether you're an investor, you have to be putting your money away towards investments, and you just got to understand what type of risks you want to take. The second thing you want to understand is how the system works, because the first time I learned this, I got a little angry because I had never understood why I was never taught these types of things, because our system is designed to benefit business owners and investors. Yet we're taught to become employees. So if the system is designed to benefit business owners and investors, how come we're not taught to become business owners and investors? It just never clicked with me. That's one of the reasons why I started this YouTube channel, to help teach people the way the system works. That way you can become an investor or a business owner, depending on what it is that you like, because even if you work a job, you can still take advantage of the way the system works. So here's how it works. If you work a job and you make, say, $100,000 a year, the first thing that happens is you're gonna pay taxes. You make money, you pay taxes, and then you spend whatever's left. After you pay taxes, you might be left with around $70,000. Maybe a little bit more, maybe a little bit less, depending on what state and city that you live in, but around $70,000. But if you are a business owner or an investor, things get a little bit flipped. Because now what happens is you can make $100,000, and then you get to spend the money, and then you pay taxes on whatever is left. And the nice thing here is if, let's just say you have $70,000 left, well, now you're going to have a lower tax rate because you have less taxable income. And on top of that, investment income has a lower tax rate than ordinary income, which is the income you get from your job. So you have a tax rate that you pay for the income that you work for, and then you have a separate tax rate for the income that you don't work for. And the income that you don't work for, your investment income, has a lower tax rate than your job income. So if you're an investor, you get the benefit of a lower tax rate and potentially less taxes. Now, if you're a business owner, you can spend this $100,000. And I'm going to give you a couple examples here because I have a couple companies. I have my briefs company, my market briefs, my business briefs, and then I have Minority Mindset, which is my personal brand. Well, for my personal brand, I have to buy things like my cell phone. I have to have things like my laptop. I have to go on trips, that's flights. I have to rent Airbnbs. I have to go out to dinners and meals and lunches with my team. All of these things are tax deductions for me. They become deductions against my income, which means I earn the money, I spend money on the meals, I spend money on the travel, I spend money on the things that I need to run my business, and then I pay taxes on whatever's left. Like I spent the last month and a half in Manhattan, in a beautiful Airbnb, in a beautiful part of downtown Manhattan, and it was great. I got to go out to some of the best restaurants, had some amazing business meetings. I was there for work, I was meeting people, I was networking, I was doing a lot of interviews, doing a lot of stuff over there for work. But all of these travels, all of these things that I did were tax write-offs for me because the tax code says that you can do that. Now, you can't do that unless you understand it. Now, once you understand it, now you can start to see, how can I create something like this for myself? There's a few different things that you can do. Now, at the kind of base level, the first thing that you can do is see, maybe I can start a side hustle. Because if you can create some sort of 1099 income or a side hustle income, well, now you just created your own business. It might not be $100,000 a year or $1 million a year. It might only be a little bit of income. But to run your side hustle, you might need a laptop, you might need a phone, you might need a car, you might need to put gas in the car. Now, these types of things start to become write-offs. They can help lower your tax liability as long as you use it for your business. Then maybe you take it one step further. Now maybe you're trying to start a business. Now you can start doing a whole lot more things in terms of taxes. I don't recommend starting a business because of taxes. Start a business because you love the idea of producing some value, of creating a product. The taxes are kind of a byproduct benefit because if you hate the idea of starting a business, well, you're gonna hate this whole stuff because yes, you get a lot of tax benefits for running a business, but it's also another headache of managing the taxes. You need to make sure you have a good accountant, having a good bookkeeper, having the right systems and processes in place to manage all your income. Because if you're doing this type of stuff, well, the IRS is watching you, so you want to make sure that you're doing everything in line with what the rules say. So you want to make sure you actually enjoy this and you're not just doing it because of the taxes. But now, going aside from the business side, if you're not creating your income, well, then you can also have your assets pay for your income. If you invest your money in the stock market and you can grow your money in a couple of years and make $100,000 worth of profit, well, this $100,000 worth of profit is going to be taxed way lower than the taxes you would pay if you earned this $100,000 from your job. Why? Because it's a different type of tax, it's a different type of income. Your job income is called ordinary income. Your investment income is capital gains. They pay different types of tax rates. And capital gains top tax rates right now are 20%. Maybe a couple other percent if you're making over $1 million a year, but around 20% is the maximum that you can pay. So if you make $10 million or $1 million from your investments, you're going to pay 20% in your capital gains taxes, versus if you made $1 million from your job, well, you're going to pay a lot more than 20%. You're going to be paying close to half of that in taxes. And then if we go into real estate, now it gets even more exciting because now when you start generating income from your real estate, you have other tax breaks and other tax deductions, which will allow you legally to keep cash in your bank account and tell the IRS that you made $0 a year in profit. This is something called depreciation. This is where now you can tell the IRS every single year, yeah, I made a few $1,000s worth of profit, but my building is 1 year older. And because my building, my investment is 1 year older, I deserve a tax break, a depreciation deduction, that's what it's called, which now says on paper, it's called a paper deduction because you have the cash in your bank account, but on paper to the IRS you say, yeah, I made a few $1,000s for the profit, but I need to get a $3,000 deduction for the value of my property because my property is 1 year older, and now you pay less in taxes even though you still have the cash in your bank. And then if you go and sell your property and you made $100,000 of profit, so you bought your property for $200,000, you sell it for $300,000, you have $100,000 of profit. Well, if you take all 300 grand and you invest it into a bigger property, that's paying you with more cash flow, that's giving you bigger tax breaks. You pay $0 in taxes on the $100,000 today. And you can keep flipping it year after year after year. You have to hold it for longer than a year, but you can keep doing this again and again and again. Keep buying bigger and bigger properties. And if you do this until you die, you never have to pay a penny in taxes. This is where it pays to understand the system, because it's not how much money you make that matters, it's how much money you keep. And one of the biggest expenses for people is taxes. And this is where now you are incentivized to invest your money. You're incentivized to start a business, but most of us are never taught this. And this is where it pays to understand the system. That way you can use the system to your advantage, but you can't use the system to your advantage if you're never taught how to do it. This is why I say that everybody in America needs to be a business owner. This doesn't mean that you need to operate or manage a business, because most people should not be in the business of operating or managing a business, but everybody needs to be a business owner. How do you be a business owner? Well, you can invest in the companies. When you invest in the McDonald's company, when you invest in the Amazon company, you become one of the owners of these companies, and you get to share in the profits with your equity, because now you have equity in these companies. It's the same thing when you start a side hustle. That's another way to do it. If you want to be more actively involved, you can start a side hustle, take advantage of some of these things, and start creating your own income. This brings me to number 3, but before I go into that, if you are an entrepreneur, if you have a business, and you want to stay up to date on what's happening in the business economy, you want to see what's happening in the entrepreneur trends, what's happening in the business world, I created a free newsletter called Business Briefs, where my team is breaking down what's happening in terms of innovation and funding and the startup economy, that you can read every single day, Monday through Friday and Sundays. We break down all the things that you need to know. That way you can run your business even better. So if you want to join Business Briefs for free, I'll get the link to how you can do it down at the description below. The third thing that keeps so many people poor is that we spend money based off of what we feel like we deserve. We live in a consumerism culture, which means that we are bred to spend. We see people buying all the nice things. It's completely normal to go into debt in America to have stuff that you can't even afford. That's just the way that our culture is. And now, if you want to become wealthy, the first thing that you need to do is stop spending so much money. How do you do that? Stop buying things that you can't afford. The reality is we live in a society where it's completely normal to have credit card debt. It's completely normal to use buy now, pay later, or as I like to call it, broke now, broke later. I love the way Dave Ramsey says it. Dave Ramsey says, act your wage, and this is so important here, where you don't spend based off of what you deserve, but rather what you earn. And the easiest way to remember how to do that is a rule of 5. If you can't buy 5 of them, you can't afford 1 of them. Now, what this is going to make you do is you're going to know what you can actually afford. Because in our society, just because you can't afford something doesn't mean you can buy it. You can buy pretty much anything that you want. If you want to buy a $1,000 laptop but you only got $100 in your bank account, no problem. Just put on 18-month 0% APR financing. If you want to buy a $30,000 car but you only make $25,000 a year, no problem. We can put you into easy credit. That way you can buy this car that's going to take you forever to pay off. And by the time you pay it off, the car is worthless. And then you got to start the cycle all over again. This is where now you got to start changing the way that you spend your money. And it's hard because as soon as you start living below your means, everybody's going to look at you like you're the crazy one. What do you mean you don't want to go out to eat with us anymore? What do you mean you don't want to go to the club? Is something wrong? Are you sick? Are we not good enough for you anymore? The fourth thing that keeps so many people poor is what we're taught to do with our money. Like growing up, I was always told that if I want to become successful, I need to do 2 things. First, I got to become a doctor, because if you're a doctor, you make a big income. And then the next thing you want to do is save as much money as possible, because your savings are how you become wealthy. Your investments are risky. Why would you want to put your money in real estate or stocks? Because that's risky. You can lose all of your money. But if you save your money, you always know what that money is. If you put $10,000 in the bank, you can look at it tomorrow, it's going to be $10,000. You can look at it in 12 months, it's going to be $10,000. You can look at it in 10 years, and it's going to be $10,000 and 5 pennies because of the interest that they give you. But the whole idea is your $10,000 or whatever amount that you save is safe in the bank. But if you dig a little bit deeper, this is what financial education teaches you. The reality is your $10,000 is not safe, because the cash that you put in the bank is actually losing value. It's guaranteed to lose value each and every year because of something called inflation. Inflation is, well, it's become very popular now, but inflation is when the value of dollars go down, causing the price of things to go up. That's why things are more expensive today than they were 30 years ago. And now inflation has become a lot more popular, where more and more people are starting to learn about inflation. But the funny thing about inflation is I've been talking about inflation way before inflation was cool. Like in 2016, when I first started making YouTube videos, my first video to go viral was a video called "You're Guaranteed to Go Broke If You Do This." And the whole premise of this video in 2016 was if you save all your money in the bank, well, back then inflation was 2% a year, and the bank was paying you nothing, just like it's paying you nothing today. Well, back then I would say you're losing 2% of the value of your savings each and every year that you save your cash in the bank. So it's a guaranteed loss. Well, today, inflation is a lot higher than 2% a year, which means that now if your bank is paying you less than what inflation is, you're losing value in the bank. Your savings are literally making you poorer each and every year because your savings will buy you less next year than they will this year. Your savings will buy you less in 5 years than they will today. And so every single year you work to put aside these savings, but your savings are just walking backwards. It's going downhill because they keep losing their value. And this is where you got to understand how to save your money strategically, because there is a time and a place to save. You want to save your money for 3 reasons, and 3 reasons only. You want to save your money for emergencies, somewhere between 3 months and a year's worth of expenses. That way, if you lose your job, something bad happens, you have cash to fall back on, and that way you don't have to go into debt when something bad happens. Second, you want to save your money for an investment. And third, you want to save your money for big purchases. You want to buy a house, you want to buy a car, you want to buy some diamonds, you want to buy some nice stuff. Nice. But you need some cash to do that, so save money for that. Besides these 3 reasons, you don't want to be saving your money because now your savings are just losing value. And most of us, myself included, were told that if you want to become successful, just keep saving your money because that's how you become successful. That's how you become wealthy. Your savings are safe, when in reality, it is not safe because your savings are losing value every single year. And this is where you want to be saving your money strategically. That way you save your money with a purpose, but then everything else is being invested that it can grow, because now if you don't do that, your savings are going to make you poorer and poorer and poorer. And the reality is inflation disproportionately hurts the financially uneducated and the poor, and it disproportionately benefits the wealthy, the investors, and the business owners. And this is where you got to understand inflation isn't going away. It's been around for a long time. Even before it became cool, inflation has been around for a long time, and this is where you got to understand it's going to continue to be around, and you got to change the way that you use your money. But that starts with you changing the way you look at money, and that's all about the financial education, which brings me to the next point. You hate the idea of success. Now you might hear that and say, but Jaspreet, who in the world hates the idea of becoming successful? Now you might not directly think you hate the idea of successful, but if you hate successful people, you hate the idea of becoming successful, because there's a growing trend. I don't want to call it a movement, but there's a growing trend of it becoming very common and popular to hate the whole idea of somebody becoming successful. You hate successful people, you hate people who have money, you hate the idea of somebody becoming rich. But if you hate the idea of somebody becoming successful, how in the world do you think you're going to become successful? And this is where now you can start to dig a little bit deeper the more you start to scratch the surface, because now you can say, well, there's a lot of people who hate the idea of expensive things. I went to dinner with a friend of mine, and this was in Manhattan, and he looked at the prices at the menu and was like, how in the world can this restaurant get by charging $50 a plate of food? What a ripoff, what a scam. And this guy had a business. And, I let him kind of talk, and I was like, well, they provide a different level of service and value, and yeah, it is pricey, but it's nice. It's nice, especially if you can afford it. You're getting something a little bit different. If you want a discount, then go somewhere else. And, we started talking a little bit more. I don't like to really tell people how to think, but I started to push him because he's a good friend of mine. And I was like, how about your business? Like, how would you feel if people said the same thing about your prices? And he was like, people do. People always hate about my prices. They say it's too high. I'm like, well, maybe if you start changing the way that you start looking at prices, you might start changing the way people start looking at your prices. Because if you can charge a higher price because you provide a different value, well, now You're going to want people to pay for that higher value. And it starts with you changing your mindset, because if you want to become successful, you got to change the way you look at things first. You got to change your mindset before you can change somebody else's mindset. And this is where you got to understand that if you want to become successful, you want to become wealthy, you want to become rich, whatever word you want to put on it, you got to change the way that you look at success. And I think part of the reason that people hate the idea of success is because we always assume that if somebody became rich, somebody became successful, they must have done something bad. They must have cheated somebody, they must have done something illegal, they must have done something fraudulent, when in reality, yeah, you have some people that did that, but most people who become successful have done it through hard work, they did it through learning, they did it through sacrifice. And this is where now, if you start flipping the script, instead of saying, why did they do it? Understanding how did they do it? That way you can do it for yourself. It's going to change the way that you look at other people's success, and it's going to change the way that you look at your own success, and it's going to change the way and the things that you do to become successful. You know, I talk about mindset a lot here, because minority mindset is all about changing the way that you think. Stop thinking like the majority of people. It has nothing to do with the way you look or your ethnicity or their skin color. It's all about the mindset of thinking differently. Because the reality is, if you keep doing what everybody else does, and in this case, it's hating success, it's hating people who have money, it's hating the whole idea of becoming successful, well, you're never going to do it yourself. You have to change the way you look at success if you want to achieve that success for yourself. Our economy, along with pretty much every economy in the world, moves in cycles. They kind of move like this, where if you zoom out and you look at our economy or any economy over the last 100 years, what you'll see is that they have these boom and bust cycles, where over the long term, the economy grows on average, but then along the way, if you look a little bit closer, you'll see booms and busts and booms and busts and booms and busts. Now, sometimes you're going to have bigger booms and bigger busts than other times, like when the 2008 crash happened. That was a major bust in the economy. The economy saw a massive crash. The Great Depression was a massive crash. Sometimes you have smaller recessions, smaller busts, and so you have to understand, though, on average, this is what the economy looks like. We have these booms and busts. They happen because now that you understand this, you can start to master your psychology, because most people hear the word recession, or they hear the word economic slowdown, or they hear the word market crash, and they get anxiety. They freak out. They stress out because they're shocked. How could there be a recession? How could we see a market crash? How are these things possible? I thought everything was perfect. But if you just look at the history, you'll see that these things are a part of the economy, and there's nothing for you to be surprised about if you understand how the economic system works, because now, instead of being shocked by it, because the people who are shocked by it are also the ones who are hurt the most by it, and those are the people then who end up losing the most money. So now that you understand that, hey, these booms and busts happen in the economy, now it's, how do I capitalize on it? Because there are different ways to make money when you're up here in the economy, and there are different ways to make money when you're down here in the economy. Now, if we start with just the basics, many people think that the way that you make money is only by buying low and selling high. So if you buy here, sell here, well, you just made money, right? Well, that's one way that you make money, and it's a great way that you can make money if you can perfectly time the market. However, most people can't perfectly time the market. What ends up happening with a lot of people is they say, oh, I'm going to buy it at the bottom. They see the market going down, and then they see it go down more, and then they say, well, I think that the market's going to go down even more. I'm going to wait for a little bit more of a drop, and then I'm going to come in and buy. But then what happens is the market starts to go up, and then they say, oh, this is too expensive. I don't want to buy it right now. I'm going to wait for the market to drop even further. And then the market goes up, and now you say, oh, this is too expensive. This is a bubble. This is too late. I don't want to buy anything. And then it goes up even higher, and now you realize that you missed it. You missed a great buying opportunity, and now you're just sitting there twiddling your thumbs while other people who came in and bought, who didn't try to perfectly time the market, are making a ton of money. I have made the same mistake before. I started buying real estate after the 2008 crash, and I was in Michigan, where the economy was hit extremely hard because the Michigan economy was super dependent upon the automotive companies, Ford, GM, and Chrysler. Well, GM went bankrupt, Chrysler went bankrupt, and Ford was on the verge of bankruptcy. So the real estate market in Michigan was decimated. And I mean that you saw properties selling for, in some instances, 90 to 92% off. And the first property that I bought was a small 1,000 square foot condo in a good area for $8,000. That wasn't the down payment, that was the total price of the condo. I rented that condo out after I bought it for $600 a month, and I put in a few grand worth of repairs. So I made a great return. Now that condo that I bought had sold for right around $150,000 just a few years prior to me buying it. So I started buying properties when they were at dirt cheap, when they were at rock bottom. And I bought a few properties under $30,000. And then I started to see home prices start to go up. We started to see this happen. And I remember this vividly because I was looking at homes in great areas, great neighborhoods. And these homes were selling for now around $50,000. And remember, I was young then. Like I started buying real estate when I was 19. And so I didn't understand how the real estate market worked. I didn't have any mentors. I didn't have any guidance. I didn't have real estate family members. So this was me just trying to figure it out myself. And I remember looking at these $50,000 homes thinking, this is too much money. Who would pay $50,000 for this 4-bedroom, 2-bathroom home in a great neighborhood? And I didn't know anything else because this was the only thing that I was ever exposed to. This is the first time that I ever got any real financial education. So I started turning down homes because home prices started to go up and I was like, this is too much money. This is no way that this is going to be sustainable, that this is too expensive for a home. Well, those $50,000 homes are selling for $300,000 to $400,000 today. Maybe even a little bit more. And so now I'm kicking myself like, dang, I wish I just understood what was happening a little bit better. That way I could buy even more. Now, of course, I did take advantage of what was happening. I bought a handful of real estate during the bottom and I made a great return on all of these properties, but I learned that these types of booms and busts happen, and there are different ways that you can make money on the top, and there are different ways that you can make money on the bottom. Now, what some people think is the best way to make money at the top when you're in this type of top of the market is to short the market. Now, shorting the market means that you're betting against the market, and you make money now when your stock or your investment goes down. So if you buy something and it goes down, well, now you made a profit. That's how you make money with shorting. I am not a shorter, because that is too risky for me, because you can lose more than all the money you invested, because there's no limit to how much money you can lose, because now you make money when your stock or investment goes down, but if it goes up, now you owe money, and it can go up to infinity, right? There's no cap to how high something can go, so there's no limit to how much money you can lose, which is why I don't short. I like to buy, which is just my investing strategy. But now there are different ways that you can buy at the top, and there's different ways that you can buy at the bottom. I like to call it a passive and an active strategy. I'm going to talk about this in number 2, but this is where you have to understand that the way that you invest is going to be a little bit different at the top and the bottom. But your strategy, your general strategy is not going to change. It's just the way that you execute your strategy, because the opportunities are going to be different here versus here. And this is where now you have to understand a little bit how the economic cycles work. That way now you can take advantage of this, but this requires you to be educated on how do you actually invest your money. Let me first talk on a general level, then I'll get a little bit more specific on how do you actually invest your money. So on a general level, when it comes to investing your money, there are 2 different ways that you can put your money to work. You have fundamental versus technical. Technical is your traders. These are the people that are looking at stock charts, they're looking at stock candles, and they're trying to get in and out of an investment or a stock quickly. So these are your home flippers. These are your stock traders. People that don't want to hold on to an investment for the long term, they just want to buy it and sell it for a quick buck, whether it's in 2 days or a year and maybe some change. So it's like a year worth of holding something. You don't want to hold this for less than a year. You are a trader, and now you're looking at the technicals. I am not a trader. I am not a good trader. I did try trading for a little bit because it was exciting and it looked like it was really fun, and people kept talking about how much money they were making, and I tried it for 1 summer when I was in college, and it sucked so much time out of my life, and it sucked so much energy out of me because you're constantly glued to the screen trying to figure out how it works, and I realized I'm not a good trader. So I don't trade, I don't advocate trading, I talk about fundamental investing. Now fundamental investing is now where you invest into an asset, something like a stock or real estate or whatever your investment is, and now you want to hold on to this for the long term because you believe in the underlying value of your investment and you think that you can come in and buy it at a good price. That way now as your investment continues to provide good value, they continue to get better, it continues to produce more, now your investment will become more valuable and maybe it's also paying you dividends or royalties or some sort of income along the way. And so now you're just holding on to your investment for a long term and that's how you become wealthy through these fundamental investments. Now, if we dig a little bit deeper, within fundamental investing, there are two general ways that you can invest your money. You can invest your money actively or you can invest your money passively. Now, let's start by talking about the passive investment because passive investing is a little bit easier to understand than active investing. Passively investing is where you ignore the market cycles, you ignore what's going on in the economy, you find some good investments, and now every week or every 2 weeks or every month, you are just putting some of your money to work no matter what. No matter what's going on with the economy, whether the market is up or down, you are consistently passively and ideally automatically investing your money. So I do this type of passive investing and I passively invest my money into 3 places. This is just what I do as an example. I'm not telling you what to do. I passively invest my money into the stock market, into cryptocurrency, and into physical gold. So the way that I do this in the stock market is I have some ETFs that I invest in. An ETF now is a group of companies. So it's not investing in one individual company. I'm investing into a basket, into a whole group of companies. Some of these are like the S&P 500. It's a group of the 500 biggest companies on the stock market. Some of these are companies, ETFs, that pay out a dividend, high dividends. Some of these are ETFs that are investing into emerging markets, countries like Brazil, China, India, Korea, countries that don't depend on the dollar and don't necessarily fully rely on the United States economy as some extra diversification. I also invest in some ETFs that give me exposure to technology and innovation because I like this. So I have picked these ETFs and now every week I have money that's automatically pulled out of my checking account and deposited into these ETFs. This happens here and here. It does not matter where in the market cycle that we are. I'm just letting my money constantly, actively, passively, and automatically be invested. So that's how I do it in the stock market. Then when it comes to cryptocurrency, I'm investing my money daily into some cryptocurrencies that I believe in. Now, if you don't believe in cryptocurrency, if you don't like cryptocurrency, don't invest your money in cryptocurrency. It's something that I believe in because I like the technology. But what I do is I have a couple cryptocurrencies that I like to own, and I buy a little bit of them every single day. Again, passive, automatic, and it's consistent. Third, I buy physical gold. Now, the way that I buy physical gold is also passively, where now once a month, I have money that's leaving my checking account and it's automatically buying me a little bit of physical gold every single month. Now, if you want to see how to do this, I have listed some of the apps that I use down in the description. You can check them out. Most of them are affiliate links, meaning you will get compensated if you use them, but you can do your research. If you like something better, that's fine. I'm just letting you know what I'm using. That's how you passively invest your money. Now, actively gets a little bit more involved now. This is where now you're not just automatically investing your money. Now you're paying attention to where you are in this market cycle, but you're also paying attention to the individual investment. So an easy example for me to give you when it comes to an active investment would be to talk about real estate, because I am a real estate investor. And so now when it comes to me investing my money in real estate actively, I am looking for a good real estate deal. That means I have my own criteria. I want a 7% cash on cash return on my money. So if a real estate investment requires me to put in $100,000 worth of cash into the deal, I want to make sure that I'm getting $7,000 worth of profit every year for owning the property. If a deal is not giving me $7,000 worth of profit, I'm not going to be interested. So I create these types of rules, and I'm looking for deals that meet my criteria, including a good location, it has the right type of property, it has the right type of field. There's a lot of different things that I look for in the actual real estate deal, but when it comes to the financials, I want a 7% cash on cash return. Well, when we're in this type of market cycle, at the top, it becomes much harder for me to find this type of 7% return. Is it impossible? No, but it's become much harder. when we're at the bottom, finding this type of 7% return isn't as hard. And so the number of deals that I can find is much better. I can find even better returns and I can find more deals. So now when it comes to me actively investing my money, I'm going to probably be actively investing more down here in the bottom half than I am up here. Does that mean that I'm not investing up here? No, I just need to make sure that it's still a good deal, that I'm still getting the returns that I want, but I have to be a little bit more picky and I got to do more research. It's the same thing in the stock market. Now, when you find a good company that you want to invest in, you got to do the research. What type of company is it? Are their revenues growing? Are their profits growing? Are they creating a good product? Do they have a good executive structure? If you find a good company, you'll make a list of companies that you like. Now, what you're looking for is a good buying point. Now, there's two things that can affect the buying point. One can be the external economy, and second could be what's internally happening at the company. Because now you can have a great company that's doing really well, that's growing their profits, but the economy is tanking. And if you have a great company in a tanking economy, well, you might see the stock price fall, not because of what's happening at the company, but because of what's happening with the economy. This can create a great buying point for you because now you're getting a discount just because of what's happening in the economy. Likewise, a company could be on the verge of a turnaround, but the market hasn't seen it yet. So now you could be at the top of the market. The company is not doing great, but you're seeing it start to turn around. Well, now this could be another buying point for you because now the price is lower, not because of what's happening in the economy, but because of what's happening internally at the company. So this requires an extra level of financial education where now you're digging deep into how do you actually invest your money, and now you're looking into this active investing. Now, where is it that you want to invest? Because you have to be educated in your investment style. And what I mean by that is that you're actually learning how do you invest your money in this asset class. So the major asset classes would be things like stocks, real estate, cryptocurrency, physical gold, startups, investing in your own business. These are the places where now you can invest your money. I just talked about the different ways that you can actively invest, but now you have to get educated on how you actually do it. We have a ton of videos on my channel you can check out. We have a free ebook on passive investing, which if you haven't read yet, I recommend that you read it, where it's a guide on how do you start investing your money, how do you start generating passive income, even if you don't have any money or if you don't have a lot of money, even if you have just $100 to invest, it'll give you some guidance on how you can start investing. If you want to read my passive investing guide, I'll link it for you and how you can download it for free down in the description below. But then you can also go a little bit deeper. Then you can start reading books about things that you're interested in. Read books in real estate investing, stock market investing. And then if you want to learn more, you can even go out and purchase classes. But the best thing that you can do, the best thing that you can do if you want to learn how to be a good investor is to actually invest and get the experience. Because experience is the best teacher because you're going to make mistakes. And some of these mistakes you can't read about in books. I made a video on my channel about my worst real estate deal ever. I'll also link it for you down in the description. But in this video, I walked you through my worst real estate deal ever. I walked through every mistake that I made. It was a painful process, but the number of lessons I learned from that one deal set me up to do so many bigger deals. But it was a painful process, and those were things that I could not find in books. No matter how many real estate classes or books I took, you're not going to find that information because some of these things that you learn from experience, you can't get anywhere else, so you cannot replace that experience. Third, now if you want to take advantage of these types of active investments, you have to be prepared. And the way that you're prepared is you just got to have cash. You need money to be able to capitalize on these investments, or you need access to capital. So how do you do that? Well, the way that you do that is you prepare when times are okay. So when you have an income and you don't have that many expenses, you need to be putting some cash aside. Now, there's a couple ways that you can do this. Obviously, you keep passively investing your money, but then you can also put a little bit of money every time you get paid aside for an investment fund, where now you're just waiting for a good active investment. And so the key here is to be prepared when times are okay, that we can take advantage of opportunities when times are not okay. So what do? Well, you can increase your income or you can decrease your expenses. When it comes to now decreasing your expenses, the first thing that you can do, which is the simplest, which doesn't require you to cut back on anything, is to call up all of your subscriptions. So your internet company, your cable company, all of these utilities that you have, just call them up and ask them for a discount. And the way that you do that is you just start looking at all the competitors, see how much money they're charging, and see if you're overpaying. Because sometimes what happens is you get stuck into an internet company or your cell phone company or whatever company, and you don't check your bill for a little while, you just keep paying it, but then they just keep raising your prices. And then the competitors start offering new introductory rates. And no company wants to lose a good paying customer to their competitor just because they're offering a lower price. So now what you can do is you be nice to the customer service agent and you say, hey, I noticed my bill is now $110. I used to be paying $75 a month. Is there anything that you can do? Let them see if they will bring you the bill down. And then you can say, well, I see that your competitor is also charging $55 a month. Is there any way that you can match that? I don't want to leave, but it's a pretty big price difference and I might have to leave if you can't match the price. Now, if they match the price, well, now you just saved a whole bunch of money on your bill and you didn't have to change anything. You don't have to downsize, you don't have to change, you just got a cheaper price. The second thing that you can do to find some extra cash is just sell some of the stuff that you're not using. Every single person has stuff around them that's collecting dust, that doesn't do anything. And so if you have a bunch of junk around you in your home, in your apartment, in your storage, well, maybe you can just sell some of it and turn this dust into cash, and now you have some cash that you can use to take advantage of opportunities through this active style. Now, the next thing is obviously you can increase your income, and there's a lot of different ways you can do this. You can start a side hustle, you can try to start your own business, you can look for another job. And so if you now are increasing your income, the key is you don't just increase your lifestyle to match your increased income, because now you have no more extra cash being put aside to take advantage of opportunities. So the key here is to create a margin where you're spending less than what you're earning. That way you have cash put aside for your investments. You need cash for your emergency savings. You want to have cash for your regular spending, but then you also want to have cash put aside to take advantage of investment opportunities that might come your way. Fourth, this is where you have to actually take action. Now, one of the things that you can do here is understand how to manage your risk, because one of the things most people are scared of when it comes to taking action is what happens if I lose money? Well, the first thing is now you manage your risk. And the best way to manage your risk is by getting educated, because the more educated you are, the less risk you take. But this is where now you want to take calculated risks. We're not just throwing your money into meme coins or into meme stocks, hoping that you can double your money in 30 days. This is where now understanding that you want to be an investor where you're doing more fundamental investing, where now you're researching your company, you're researching your investment, because the more research you do, the more you can limit your risk. And this is the same when it comes to stock market investing or real estate investing or cryptocurrency investing. The more research you do, the more educated you will be. But this is where also you have to understand that there is a chance that you will lose money, because investing is risky. You're never guaranteed to make money when you invest. You might even lose money, which is why you should always do your own research and never blindly listen to a random guy on YouTube. Now, when it comes to now investing your money, if you don't want to feel scared of losing your money, think of your invested money as lost money. That's one of the easiest things to do, where if you take $1,000 and you invest it, think of that money as gone. Because if you're trying to stare at your stock market portfolio every single day, it's going to cause anxiety, it's going to cause stress, it's going to make you panic when things go down, it's going to get you excited when things go up. And when you are an investor, you don't need to get so excited and emotional when it comes to investing your money, because that short-term richness is loud, but wealth is whispered. And so now if you want to become wealthy, you don't want to be constantly keeping up with their investment. The way that you want to do it now is just be researching the companies or investments that you made and make sure that it's a good investment, and then letting time run its course. If you don't want to get into all that stress now, you just invest your money, think of it as gone, and I just check it once in a while to make sure that you're still investing in good companies, but understand that investing has risks, and the way that you mitigate those risks is by learning. That way you can manage your investments the right way. Everybody's always trying to time the market. Everybody's thinking, oh my God, the market's going down. Should I wait for it to go down more? I think the market's gonna collapse. I don't want to start investing now. Or they say, oh, the market's at the top. Why would I want to buy now? You're gonna lose money. Everything's gonna bust. But nobody can perfectly time the market, and the people who try to time the market miss out on all the opportunities. And this is where now, instead of trying to perfectly time the market, what you want to do is create your own strategy, create your own rules, and then when you find a good investment that fits your rules and your strategy, it fits your investment criteria, make the investment, because you're going to learn the most by doing it. And if you just sit on the sidelines, not only do you not get any of the action, you don't get any of the upside, and you don't get any of the learning. So it makes sense for you to go out and invest. And if you're still scared, start with a smaller amount. You don't have to start by investing all your money. Start with a little bit. That way you can start to get the feel of it, get a taste of it. That way you can at least get started, because as soon as you have some skin in the game, as soon as you put some of your own money into the game, that's when you're going to learn the most. And this brings me to number 5, which is investing your money for the long term. And the reason why this is so important is because if you are a fundamental long-term investor, timing the market doesn't become so important, because now let's assume that a little while ago you made a mistake. You bought at the top of the market. Although you bought a good investment, you bought at the top of the market, and as soon as you bought, things went down. Well, what could happen if you buy a good investment is, well, you bought it at the top, right here. As soon as you bought, things crashed, and now you see your investment get cut in half. Now you feel very sad. But then things start to rebound, and then they go up, and then they go down, they go up, and now you look, after a few economic cycles, you see where you are, and you're a lot higher now than you were before. Even in the next boom or bust that you see, your bust is still higher than where you bought when you were at the top. And so this is where now it's about not just trying to time the market, but time in the market. This is one of those things that Warren Buffett keeps talking about, where everyone's trying to perfectly time the market. But instead of trying to time the market, have a good investment that you find at a good price, meaning it fits your investment criteria. And even if you buy at the top, understand that if you're a long-term investor and it's a good investment, that things will continue to rise. You still have a lot of upside ahead of you. This is why you want to have that mindset of understanding that you're not a trader, because traders think very differently than fundamental investors. Traders are thinking about the next 12 months. Fundamental investors are thinking about the next 12 years. And so it's a very different mindset. And if you can pull yourself away from the emotions, you'll be able to reap the rewards, because traders can make a lot of money in the short term, but they can also lose a lot of money very quickly. Fundamental investors are the ones that make the most wealth, but it also takes the most time. But it requires you to be more patient and understand that if you have a good investment, you just got to give it time. And sometimes when you're just staring at the stock portfolio, it can be very anxiety driving, because you keep seeing your portfolio go down and down and down. But now this is where you just want to take a deep breath and understand, is it a good investment? Is it something that you want to own for the long term? If yes, then let the market do its thing, because the market can be very volatile and very wrong in the short term, but over the long term, it will eventually correct if it is a good investment. And over the long term, you will see the investments that are more valuable will grow in value, because investors will want to have the stronger, better investments, but it requires you to hold on to something for the long term.
But again, my focus now isn't in real estate like it was before. A few years ago, I was heavy in real estate, and I was doing everything that I can there, and a lot more opportunities were there. I bought a property in 2021, haven't bought anything in 2022 yet. But my focus now is building my business, because I see a bigger opportunity there for me than real estate. That's why I'm still involved in real estate, right, but not the way that I was a few years ago.
Because you can earn more with your business.